My next guest has a buy rating and notes they import less than 10% of their products from China, which could insulate them from the tariff impact. Let's bring in Lorraine Hutchinson. She's BofA's senior retail analyst. Lorraine, it's great to see you. Let's just dwell on this one for a moment. After that failed, they were taking over, or Capri was taking over them. Regardless, it doesn't seem to matter now.
Well, Kelly, that deal's off the table. So Tapestry was going to buy Capri, but that's been completely walked away from at this point. And I think what you're seeing today is the strength of the Tapestry platform come through in earnings today.
And that's the owner of Coach and what other brands?
Coach, they own Kate Spade and they own Stuart Weitzman. I think the highlight today of this earnings release was Coach sales up 10%. Which everybody's laser focused on right now. To me, there are two much more important data points underlying that growth. Number one, Coach is attracting a younger customer at higher price points, which every brand really wants, right? And number two, they're doing it at higher margins. Gross margins were up 280 basis points this quarter. That was a huge surprise. And both of these factors really highlight the strength of the brand and the consistency of what we'd expect on a go-forward basis.
I should have known if everything else is coming back into style from 20 or 30 years ago that Coach would be the logical next choice. Where else? RL, I know that's not one you cover per se, but they had a strong period. It's an odd moment for retail. I mean, you have names like Peloton popping. The fashion mix is shifting. The tariff questions are there, but there seem to be a number of names. Is that because the bar was low that they're popping?
I think, not everyone's had a great earnings season. I think what's really standing out to me is those companies that are giving the customer value. And as I was saying, with Coach, they're bringing in customers at higher price points. Value doesn't have to mean the price. It means what you're getting for that price. So if you're getting a really well-crafted leather handbag for $300 and you're used to paying a lot more for a luxury bag, that could be a sign of value. And I think the customer who continues to struggle a little bit with discretionary wallets, is really, really looking for value in this environment. And we're seeing that in a lot of different places.
Yeah, when I think about, again, the high price of eggs, the high price of coffee, a lot of these everyday things people run into, the flip side of that is, they don't really have to shell out in areas like apparel. So that plus the tariff threat, does that leave the rest of your coverage space vulnerable to margin pressure for the rest of the year?
Sure. I mean, look, the 10% tariffs on China are really the thing we're focused on. We estimate that our group, the apparel imports, are about 10% of their total cost of goods. So if you think about that, it's only about a 25 basis point headwind to margins. That's pretty manageable. In the scenario where there's a universal tariff, where all imports are tariffed, we would see a much higher impact. And our scenario analysis assumes no price increases, exactly because of your point. The customer has been pressured by a lot of other inflationary areas in their budget. And so what that's meant over the course of most of 24 is apparel spending was pressured because they just simply didn't have a lot of money left for it. Instead, they're searching for this value to make their dollars stretch further. So we'd be looking to companies that have lower import exposure, like Bath & Body Works, that produces 85% of its product domestically, or retailers that are offering some extreme values for a stretched consumer, like the off-price space, like a Ross Stores or TJX. Those are our plays for how to manage this tariff risk as we move through the year.